S&P 500 breaks its neckline. We'll tell you what to look for. Why this is the most critical chart you need to watch Monday. Nasdaq remains wedged, but we see signs of deterioration. We'll show you what to watch for. Energy continues to remain at highs, while retail could break down. What this means for big tech. The Federal Reserve dot plot and why you should care about it. The last hour of trading and what it's telling us going forward. Short-term risk levels and what they're telling us. Smart money, dumb money broken down into sectors. We're going to explain what this means and what to look for. Why the 10-year Treasury yield over multi-decades is one of the scariest charts out there. We'll go over several stocks that are looking to break down, the Tesla news that sold the stock off on Friday, as well as what stocks have great balance sheets that look like they could hold. We have a ton to go over. Let's get to it. Hey guys, welcome back. We have a lot to go over. We're going to jump right into it. So we have the ES right here, the S&P 500, and we can see this head and shoulders from back in the day in 22. We all know why this happened, and we can see the neckline right here. We can see how we tried to get over the neckline, completely matumboed right there. We tried again here, and now we have this rejection. In order for this rejection to be considered a real rejection, the follow-through has to happen, meaning we need the lower low. Now, whether or not we get that remains to be seen. It sure seems like we're going to get that rejection, but we just don't know that. But when you start having these, you see these highs right here, and they start go lower and lower, you want to start paying attention to that, and it fits in really perfectly with this trend line right here. And we're going to get into the internals of the market today in pretty decent detail, as well as what's going on with the dot plot. So ton to cover today, and I appreciate the comments, and that's why we're covering the dot plot. I received a lot of comments where people were struggling to understand why the market actually dropped when Powell spoke, considering it was exactly what was supposed to happen. We're going to point out exactly why this happened in great detail so that you'll be able to see it for next time and be able to notice it yourself. So we're struggling with the neckline. There's two things I don't like here. Number one, obviously the DTL, downward trend line. DTL stands for downward trend line. Number two, the trend line's changing. So in other words, this is getting worse. It's not getting better. So if you have a trend line, that's fine. Sometimes you reject and then you come through. Usually first times you reject. But when it starts to get worse, you want to pay attention. Now, why? Because the trajectory is changing. In other words, you're starting to drop. So if you had this here and then this one all of a sudden was like, right in line with it, or actually was just basing and then kept bumping against it, you'd be like, that's okay. But when you start getting worse, you want to pay attention to it. It would be nothing for us to come back down here and retest this 200-week moving average. There's a couple things that we really need to focus on with the ES. Now, on these Saturday videos, and for those that are new, all these videos are linked together starting Saturday, and then we follow through on the week, and we build upon Saturday. So I'm going to try and stick more with the weekly and hourly charts. That's about as deep as I'm probably going to go, is hourly on the indexes. Most likely we'll probably just hang around weekly and daily, just FYI. But you can see right here, the MACD is starting to cross, and you don't really want to see this here. You don't really want to see that cross, and you certainly don't want to see that get worse. And now we can see that there's a trend here, a trend line, and what happened? We can see that we broke that trend line. I mean, I'm sure you guys already saw this, but I think it always helps to refresh to kind of see that, and then you kind of look where that trend line was, and that's here. Is that a forecast or a foreshadowing? You have to assume that yes, it is. Now, it doesn't mean it's going to happen, but you must go on the assumption that that is something that we're going to have to look at. Now, something else that I think is really pertinent is you can see how your RSI is broken that 70. And I always say this, I don't care that I'm, quote, overbought, because you could stay overbought for a period of time, just like you did here, right? Obviously different monetary policy, but you could see how you crack here and nobody really cares. And then you pop back over it and everyone can now see this positive, this negative divergence pretty clearly. I don't think it's absolutely glaring when you look at it this way, and then you can see the positive divergence here. I always like pointing these out because I think it's really important to point this kind of stuff out. People will say RSI doesn't work. People don't believe in gravity either, but it still works. And you can see these really clear. You can go back and look at this over the past 20 years and see the positive, negative divergences. It doesn't tell you when, just tells you it's coming. So, and it's kind of, to me, it's always crazy how that works. If you look right here and you even see this one, I mean, did it telegraph that you were going to have this monumental move? No, but it definitely telegraphed that there was a move possibly coming. So I always find it interesting when people say that they don't like it or it doesn't work. If you look right here, you've already broken as well. I know that's not the most perfect line, but here you are again. And you start looking at this and going, well, where's that going to take us? The answer is we really don't know. Now, if you look at this on a daily, you're going to note that we're already getting to that oversold. There are a couple glaring things here that I think we should point out and that you should be aware of. Number one, you can see your peak right here and how high you rallied. Now, why is that important? Because you can see how we reacted here. We got oversold and then we bounced. Look at where that bounce got us. We could barely get over the 50 line. And then what happens here? Then we crack. Now, do you notice that you're lower here and you haven't even gotten to this point yet? Right? So in other words, people would say, well, you could say that that is a positive, some kind of positive divergence. Well, it's a positive divergence if it stops and makes a U-turn. It is not doing that, right? So that's definitely something that we want to pay attention to, and it's definitely there. And again, you can just kind of see how you were unable. It's I always like pointing them out, but you can see here how you're pointing down and how this was going higher. So you are seeing some signs of telegraphing there, but you don't know if that just means you're going to go sideways. Well, at this point, you are clearly breaking that weekly head and shoulders, and as the daily head and shoulders gang likes to point out, this is sitting right there. Now, this is confirmed as far as a head and shoulders because now you have that lower low that happened. You rallied right to your neckline. I don't know if people saw this or not, but I think it's really important. Let's blow that up. You rallied right up to your neckline, and then you just reversed. And not only did you reverse, you closed lower than the previous bar. That's not ideal. That's not what you want to see. People will say it's on a Friday. At some point, we have to stop making excuses for, oh, it's Friday, oh, it's quad witching, and we just have to call a duck a duck. It is what it is, and this is what we're dealing with. The question is, where do we go from here? And spending a lot of time at the ES on purpose. You have no leadership in the market. I'm going to flip through the sectors very quickly so that we can see this, but you have no leadership in the market. So I think you're heading down to something like this 42.69. I think you might be getting easily to this 4,300 level. I just don't see a world where you're not testing the 200-day. I really don't see a world where that's not going to happen now. And that's not really saying anything monumental, right? It's less than what? I mean, it's not even probably 2% at this point. I don't even think it's anywhere near that. I think you're at like 1.5 to get there. So I don't think that's a monumental leap or statement. I actually think it's healthy at this point to test it, see how we do, and kind of go from there. You're still curving and the slope's still up, but I do think that we have to look at this and call it what it is. Now, in regards to the Nasdaq, we have the same exact setup where we took this out, we're dropping, and now people will say, well, that could be a positive divergence. It very well could, but we just don't know that yet, right? We just don't know that that's what's going to happen. I mean, you can see obviously the one from here to here, and then here as well. But nothing's perfect, nothing's 100%, guys. But when you start looking at this stuff, it starts making life very, very clear for you. I mean, you could make an argument that, well, this was a negative divergence here, and it was, right? But what happened? We just went sideways, and then we rallied. So it's not like you're just coming out and saying when you have a negative divergence, you're obviously going to roll. No, you could just have a period of underperformance, which is what you had in here. But they do exist, and I find them quite helpful as far as just painting a picture on what's happening. So did we crack yet? Not really. At this point, I think it's pretty inevitable, but you can say that and you just don't know. I think it's really hard to look at this and say that that's going to hold, but maybe it does. Maybe it does hold here. Now, looking at this bar and drilling into that, gravestones at the bottom of chart are pretty bearish. And not only is that bearish, it's like the exact inverse. And for those that followed for some time, you know how much I love when you get a dragonfly pattern at the top of a chart, because it just means that you're going to pretty much rip. This is pretty much the exact opposite. If you want to see if you're bullish right here, you don't want to see that. So what you want to look for with this kind of stuff is you just want to watch this neckline and see how you act, and that really takes you to that 14.8, right in that level. You don't really want to close over it. At this point, I don't think that there's much of a choice that you don't break that at some point. There's some news on some names that are floating out there. We're going to get into that later in the day, but let's just take out the 22 for a minute, take out the 12. For those that are new, I use a 12, a 22, and a 55. I use these to get a sense of what's going on in the market. It's very rare that I will just trade off of these intraday, but I like looking at them for a sense of the market. I use different charts for intraday trading, but for those who've been following, you are aware of that. Now, if you look at our levels in here, look at what's happening right here. See how it's turning? Watch the number right here. Watch how that number drops. So you're going to start seeing it drop right now. See how it starts to drop, starts to fade off, and now see it? You have a declining 55-day moving average. You want to try to swing trade tech stocks with a declining 55-day moving average, you're welcome to. I will not be doing that. Right? For me, it just does not work. You're really fighting the tape. And I want to just go through this again, how I view the world. And you should view the world however you want to. I'm just going to point out what I do and how I look at things. I use a 55. You should use a 50 or whatever makes you comfortable. When I use this 55, this tells me if I have institutional sponsorship or not. That's how I utilize it. So when we hit here, I'm getting confirmation that I have institutional sponsorship. I get near it, I have institutional sponsorship. I break, I close between 3 to 5 days under it, I have lost institutional sponsorship. I couldn't stay above it for 5 days up here. I lost institutional sponsorship. We have a fight. We break down, close, 1, 2, 3, 3-bar patterns for those that know it, and then you broke. That was it. You lost institutional sponsorship. That's how I look at a 55. For very simple, if I'm looking at a 12, I think this is helpful and you might want to remember this. When I'm looking at a 12, I'm just looking, do I want to look for short-term swing trades, yes or no? If I'm not above the 12 and I'm below the 12, do I want to look for short-term long swing trades? Probably not, because I'm fighting the short-term tape. And then with a 22, I just look at it as who's in charge, the bulls or the bears. So you could be at different stages here. And to me, they're different demarcation lines. And that's how I use them. But for me, looking at the 12, it's like, okay, do I really want to be swinging in here? Probably not if I'm declining. If I take a look at the NQ and I look at the 22 right here, who's in charge? Well, bears are in charge, bulls are in charge, bears are in charge. It's really that simple for me. And I just use them as demarcation lines. That's why you'll see when people say, oh, I'm looking at buying this in tech. And I'll just say, well, bears are in charge right now. Do I really want to be on that side of the trade? It just helps me as far as just an objective demarcation line. You should use whatever you're comfortable with. So I look at the line right here. I look at how we're sitting here, and that does not make me feel warm and fuzzy. You really don't have to get into the crack of the MACD. You guys are already aware the MACD is cracking if we're looking like this. I think that's pretty clear that that's what we're dealing with. And what we want to focus on are a couple things. Number one, here's your 22. We're cracking the 22 on the weekly for the first time. I see it as well, and you can see the rolling here. You can see the DTL. I'll pop them in real quick, but I'm sure you guys already saw these. And you can just see how you're acting right in there and how you held. This is what I'm talking about. Gravestones at the top of charts. Gravestones on support levels. It doesn't make me feel warm and fuzzy either. You can see you rallied up. 1, 2, 3, rejection. Bearish engulfing, tries again, boom, matumboed, and now we're below this and we're sitting on this trend line. I don't like anything about this. I don't like anything about what's happening here. So, and you can kind of see there, and now look here, now you have that negative divergence. You've already cracked, and you just haven't cracked here yet. So to me, this is inevitable. It doesn't mean it's going to happen. To me, I just don't see how this would hold. Where do you drop to? I think you have to really think that you're going to at least test here. You have to think that you're at least getting the 14.4. We've been in the community, we've been short for probably, I don't know, at least a solid week at this point through the SOCs and varying instruments, and just got out of a bunch of trades. Just letting it play out, guys. Just stay out of the way. Sometimes the best thing you can do, even if you don't want to short, just stay out of the way. And I think you're better off doing that. Now, you look at the dollar. I'm not going to spend a lot of time here. I have a belief on the dollar that it's going to go sideways. I am not sure that my belief is right. And I'm starting to see some things that are telling me that maybe I'm wrong. And it wouldn't be the first time in my life, but you see how you're starting to get wider and wider there if you get very specific. I'm not crazy about that at all. So I could be wrong here. I'm looking at this. I would look at this and say, this is my flagpole. People say it can't be a flagpole because the flag is longer than the pole. I don't really get into that super technical. I'm looking for pattern recognition. I'm a pattern trader. So I look at that and go, okay, well, and then we remember this. And I was talking about this the other day. Let me flip to this chart and let me pop that 200 in. And then we're going to take out the 12 right here. And I'm going to take out the 22 and we're going to look at this. And one of the things that I preach a lot, and I preach this a lot, and it makes my life very easy. I'm always looking for demarcation lines, guys, because they just help get me into a thesis. And when I say guys and girls, but we have over, I think it's like 15% of girls actually watch these videos, which is kind of cool considering the average is like 5. Anyway, you see these levels right here and you see these demarcation lines. That's right in there, and how you flipped. You know what happened here. You know that was the high of the market. You don't need me to show you that chart. Okay, you know this was the low of the market. You know what happened here. So the dollar rules everything around me, just like that rap song. And now look at you. And look at what's happening right there. So now what do? You watch this. And what have I been saying? I've been saying, well, that doesn't mean that we're going to go higher. That means that we could be in a range. I could be dead wrong here. We could be facing some kind of other shift in monetary policy through Japan, because Japan has really put the high in on the market. We went over this in July 27th, and the unwinding of of the 10-year trade against the Japanese bond market. So I'm not going to rehash it right now, but if you look at this and you see how you're hanging in here, I could be wrong on my thesis. and I'm starting to lean to the fact that I'm wrong. Now, we don't want a strong dollar. We're going to do the indexes quickly, but we're going to look at them because we have a lot to go over here. But if I'm looking at the dollar here, and then I start looking at the 10-year, well, the 10-year is breaking out. I'm going to leave these lines in for this argument. If you think that we don't have the potential of seeing, a 5% yield, I mean, look at this. And I want to just be really clear on this. And I'm going to leave these in. And people say, well, you shouldn't chart the yield. I chart everything. And I mean, like, I chart everything. People should do what they're comfortable with. So here you are, right? And there's your monthly death cross. Okay? What the heck is going on here? So this is a concern. Now, one of the concerns that I have is that people are not as interested in buying U.S. Treasuries for a whole myriad of reasons. And I'm looking at this and saying that this can get worse. Like if you were to look at this and forget that this is the 10-year for a second, you were just to say this is Disney. And this is a 20-year or 50-year chart on Disney. Would you think that Disney's getting ready to break out? And you would probably have to say, yeah, I think Disney's about ready to go through a multi-year move here. And that's what we're seeing happen. Now, when this first started, and I'm spending some time on this because I think it's pertinent, when this first started here, we noted it and said, hey, we're breaking. But, it's the 10-year, so maybe we should put a lot of faith into this. And then we just kind of, do the basics here and just draw that straight across. Well, support becomes what? Resistance until it becomes what again? Support. Again, if this was Disney or any other chart, you'd be going, man, I really need to buy that. Well, that means you need to sell bonds. We're looking at the 20-year and going, oh, well, it's time to buy bonds. I mean, and I'm seeing these investment banks come out for the first time and telling their clientele to buy bonds. And then you're looking at this TLT monthly, which is a 20-year, and you're looking at this going, with the yield, this uses price, TNX uses yield. I know, they could make it harder, right? So you see how you're Hing here? I'm just showing you monthly, just so you can get a perspective on your head on what's going on here over years. Well, when was the last time you were below the 200-month moving average on TLT? How about once since it's been in existence? We have to look at what's happening, not what I want to have happen, right? There's a huge disparity there, and I'll walk you through this as well because I think that this is really very pertinent. And we're not going to spend a lot of time on it, but I want to spend some time on it. So I want to look at weekly charts, and we're going to set up a real quick weekly chart here, and we're going to flip through the sectors because I want you to see this. So I want to just look at them from a weekly perspective. We're going to leave the RSI in, and we're going to leave in the 55, and we're going to leave in the 200. So this is biotech. Does that look like something you'd have to rush into right now? And I just want to look at these from a weekly perspective so you can see this. Right? Rejection. I mean, you see this, right? You see these rejections in here, and you can see how this is taking place. And there are ways to benefit from this. This is financials. So what we want to do is we want to identify the long-term trades that are still holding up because they might show us pockets of strength. Right, so we're looking at longer-term trades this week. Please comment below, but I think this 34,000-foot view of what's going on is instrumental so that we don't get caught up in the noise. As everybody that has been following this for some time, the way I do things is I do day trade, I do swing trade, and I do have long-term trades. And so I always want to view the market and have a large picture of where I think the market's going over years. And then I want to understand that in between that, you have these waves that are going to happen, right? So you just want to understand where my head is as I explain this stuff, because someone would look at this and go, well, I thought he was a day trader. Yeah, I day trade. To me, the real money is in buying and holding and finding the right sectors and coming up with a thesis. So we can get into that later in another video if you want to know how I break it down per account, but I don't know if that's interesting or boring. It's always interesting when I get asked in the comments. I got asked a lot about my computer setup, and which I always find interesting. But you look at XLP and you're like, well, this should be doing great right now because everything's weak. Does that look like it's doing great? So you're not really getting a clear read here. I'll say this: if you get a strong dollar, industrials are dead. If you get a strong dollar, I'm going to say it again: industrials are dead, right? Because Caterpillar, John Deere, when they sell their goods, Boeing, when they're not having problems with Dreamliner. All these things, you want to be involved in these names, right? That's still holding above. I still am above my long-term trend right there. I don't have my little clicker on there, so it was kind of defeating the purpose. There you go. See it? And I get questions about what I'm using to draw on here as well. It's actually a button called Screen Brush. I'm on a Mac. And it's actually really cool. And it helps a lot to find things, but I got asked a couple times what I'm using there. So then you look at gas and exploration. Well, this fits my long-term thesis on what we're talking about. So the question is, are we looking, and you start looking at Powell's body language, right? I'll go off on one tangent here, one rant. Well, what's with the iPad? So now we have an iPad that he's using to read notes. He looked nervous as heck. I mean, are we going to see some kind of resurgence here that we never really saw a double rise of inflation in our lifetime? It doesn't mean that we can't see it again. And I'm not seeing signs of that, but look at how energy's acting. Specific energy names. Look at how healthcare is acting. Do you think we should be looking long-term at Humana, Cigna, those kinds of names? I mean, this is a beautiful chart. I mean, it's really hard to look at that chart and not see how pretty that is, right? Then you go here and we take a look at XLU and we'll go and take a look at it. You know, we should really probably, I wouldn't mind doing this. Give me 1 second here, guys. What we're going to do is drop these back into the weeklies, and I wouldn't mind doing it that way. Second here. What we're going to do is throw this back there and then get that into the weekly. And I really rather just look at the larger picture right now. And so we're going to get rid of the 12 and the 22, and I want to keep that RSI in. You can see this. But you start looking at like XLU. Does that look like it's going to hold? Maybe. Or am I setting up for a death cross, a weekly death cross? I might be setting up for a weekly death cross that you haven't seen since the golden cross of 2011. Well, why would that happen? Well, doesn't that kind of fit into our thesis of what we were just talking about with yield and how yield's going higher? If yield goes higher, people don't want to own utilities. This is why you have $1 trillion sitting in money market accounts. So then you go and take a look at XLC, and this is really the sweet spot in tech, isn't it, right? If we really go into and look at the sweet spot in tech, this is it. This is your Google, your Meta, your Charter. This is those names, and we're going to go through a bunch of names later, but I just think it's important to get a sense of what the heck's going on out there. And you start looking at basic materials. Well, I thought that this would be a great spot. So far, as we run through these, I mean, what are the ones that really are lighting the world on fire, right? You're looking at, yeah, retail rejected, but there's still love for retail here, right? There's still love for XLC. There's still some love out there for healthcare. So you start seeing these pockets, and it does help you formulate a plan. And I would be looking at the ones that are above the 200-week. I'd run this. And you start looking at things like energy. Now, energy on the daily, we closed a lot of our energy trades last week because when we saw that the market weakness, it has nothing to do with what crude's going to do and everything to do with traders just locking in their year because they didn't have a good year last year. Then you look at XLK and we're hearing that, Microsoft's dead, Apple's dead. Are they? Because if you look at the weekly here, how many sectors did we just go through? How many sectors did we just go through that have an increasing 55-week moving average? So maybe we're dead for now. Maybe we're going to have a major correction. And just so we're clear, when we didn't have this injection of capital into the market that we did in 2020 from 2008, what would really happen? How did we benefit from that, right? We would have corrections that were 10% in the market every 18 months. It is great to have these corrections. Why? You don't want to go straight up. You want to have the volatility. As a trader, you make money off that volatility. And I know some days it's hard. Friday was, we did well on Friday, but Friday was a beast. Friday was not an easy trading day. Then you look at the miners here and how you're doing. So if we took this 30,000, 34,000, we'll say, view, we look at interest rates, and then you start saying, well, what happened on Wednesday? And why did this affect interest rates the way that it did? Why did this affect the market the way that it did? The best thing I can show you is the dot plot. In front of us on the left, right here, right there. On the left, this is what Goldman Sachs was saying, what was going to happen with the dot plot. We're going to get into what the dot plot is in a second. But these were the estimates of the dot plot. This is what actually came out, and I circled what we're going to focus on in 2024 and 25. Everybody's wondering what happened. We had really good indicators. The speech went well. Why the change? Why did we sell off so much? And we're going to explain it. So at the end of 2023, right here, you can see that this is where we were on the June meeting. Every single one of these dots is a Fed member, and it's what they think is going to happen. The more cohesive the pattern, the better. That means you have a consensus. More consensus means more certainty. More certainty means more ability to hedge one way or another. That just makes sense, right? You have less variance. So we can see from this right here in 23 and what Goldman said was going to happen at the September meeting and what happened. All right, so we have this one outlier here, but you can see your percent right here at 6 and then the 5.5 level, and you can see where you're at right here, and you go, okay, well, you're roughly in line with what they thought for 23. Now this is the June meeting and the September meeting. We're focused on September. Now we go into 24, and this is what Goldman is telling their clients. And you can see right here, just following this straight across, you're going to get a 5.5%, and you can already start to see the issue because here's 6%, And you have one fella up there all by himself saying, well, we might have to get a little goofy here. We might have to raise rates even more. And then you have this other person saying, yeah, I agree. Maybe not that much, but we definitely are going to have to do more than what we're doing. So then we have these outliers that skew us and give us a greater range or greater variance than what we're expecting here. Higher for longer. Then you look at the low being roughly at 4%, and then you go, well, no one here thinks that they're going to be at 4%. So we're not even in line on the low end. We're actually above it. We have this beautiful Christmas tree here where everybody's in agreement. And then all of a sudden we get to this place where we're scattered again, where somebody's up here and then we're down here. This creates what? More uncertainty. More uncertainty creates more risk. More risk means you are going to have a risk premium associated with the market that's going to change. This is what you're dealing with. We're all aware of the stool. I will not bore you with it again, but we are aware that there are three parts to pay attention to in any market. You want to pay attention to the macro, you're going to pay attention to fundamental, and you want to pay attention to technical. This is about as macro as you can get. This takes us to 25. Now, this is where it gets interesting, because 25 in September, if you look across what Goldman's telling you, is that, oh, you're definitely under that 5. You're going to definitely be under that 5. Everyone knows we're under 5, and we could be at 2.5%. Well, somebody forgot to tell 1, 2, 3, 4, 5 people what they're thinking over here, because they all feel differently. Now you could say that this person's, they might be this person here. So let's call it 1, 2, 3, 4 people are out of line. No one's in the middle, and nobody is at this low end that they're suggesting that you're supposed to be at. This causes greater variance, and you should be able to see that, how you have this tight, compact pattern versus everybody over here, every kid doing their own thing, and you have this really wide range. This creates uncertainty. Uncertainty creates more volatility in the market is the easiest way to explain it. This is what happened. This is why the market sold off. In front of us is smart money confidence. Now, we don't call this smart money. We call this institutions. We're going to break out smart money, dumb money. We usually look at it together. I think we're going to get more from it by breaking it out. And I want to walk through what we're starting to see here and why it's important that we break them out this way. I think we're going to get more out of it this way. Remember, smart money is institutional investors. We're going to look at a 3-year. We may drill into it a little bit more, but I don't even think it's going to be necessary for what I want to show you. And this is by Sentiment Trader. I have no affiliation with them. If you take a look at these peaks, when you are peaked, you tend to be putting in these valleys. And we've been talking about this for some time. When smart money or institutional money has peaked, you tend to put in a bottom. Now, the question is, you even have a little bit of a bottom here, and then you kind of see where you're at right now. Well, you certainly have not peaked. And when you put in these valleys, you can certainly see how we're putting in these tops. And the valleys don't have to be underneath. And I want to point that out. I think that's a really important distinction. We're seeing this trend, and you're seeing us rise up here. And then with that, we're seeing the market rise up. Then we're seeing this kind of come across. And then at the same time, as smart money is coming out of the market, we're seeing the market break. Then we have this inflection point here. Now we're starting to see something a little bit different, and I want to talk about it. So in other words, as we are seeing smart money come out of the market, what are we seeing here? Now we have this. Now we could argue, I'm just giving you a rough estimate of this trend line. But while smart money is coming out, the market's going higher. And this is exactly what is somewhat of a concern. I would expect to start seeing higher highs as smart money starts getting more and more invested. That's not what we're seeing. So I do have my head on the swivel with this. I am watching. If we drill into this and look at it over a year, because again, the one thing we always have to be wary of is we know that we don't have 1.7 trillion behind us. And you can see our level right here. And that is a really definitive level over 12 months, isn't it? And you can see where institutions peaked investment. And that was right when everybody was having a fit over the regional banks and we were going to lose every regional bank. And you can see how that went. Then you can see the trough value here and how that went and what that led to. Then you get a little peak here, you get a little bottom, you're trying to rally and you're at the same level that you're sitting here. So I would just really pay very close attention to this, because if I go back and let's take a look at a 5 and you see these peaks on the 5-year and what they led to, and they were bottoms. And when you're down here, it's more to me about the movement that we're seeing. So I would like more institutional sponsorship than we're seeing. If I listen to trading desks, and I do listen to trading desks, let's go take a look at 10 years so you can see, there's waves within waves, and you're going to get one wave and then another. But we always want to look at this and see what we can take from it. And what I'm taking from it right now, just showing you these different charts, is we're getting less and less institutional sponsorship. That's not where we want to be, and we want to start figuring out why that's happening. And I think that's a very important distinction, and that's the takeaway that I have in looking at this. We are getting less. We are not getting more institutional sponsorship. Not like you did back here, that's for sure, looking at this 5-year. Matter of fact, from this peak, we've been getting less and less until we came to this area, and we were looking to see if that was going to happen. Now, you can only go so high. I get that. But we've been making lower lows, and that's where the concern comes in. So we'd like to see more institutional sponsorship. I'm going to say it one more time, and I think it's something that we should be paying attention to. We obviously want to get up to here or near here, because that's where we start putting in some kind of bottom. So as this starts to increase and the market, you see, as this increases and the market drops, we can use this as a demarcation line. So we're going to be monitoring this very closely now. Now, the other thing that we want to look at is dumb money, or as we refer to this, it's not dumb money. We refer to this, let's get our little line here. We refer to this as retail. And we don't call it dumb money because it's not always dumb. Sometimes retail does a little bit better. If you take a look at it, retail bought in October where institutions did not. And we're calling the top. I refer to myself as retail just like everybody else, but we're calling the top of the markets. We're really calling the tops, not the institutions. So are we going to call the bottoms when we're not as invested? I'm not really sure on that, but what I want to point out here, and I thought this was glaring, and that's why I wanted to break this out the way that I did. Look at how we're participating, retail's participating more and more in the market, and institutions are not. And that's the beauty of when you understand what this stuff is. You can start drilling into it and say, once you understand it, so I always want people to understand what we're looking at, because now you can see that we've got more retail interest than we have institutional interest. I'm going to be real candid about you. I don't like that. Real candid. I really don't like that. I would much rather have institutional sponsorship than retail sponsorship. And it doesn't matter what I want. This is what I have. So I have to watch this, and I have to watch how this plays out, and I have to realize that we need to be at the lows really to have some kind of low. So retail needs to wash out. And now we're just nowhere near even close to washed out. We're basically at neutral. If you look at that over a 5-year, if you look at that over a 10-year, if you look at it over a 15-year, you can see the peaks and the valleys and what marked real bottom and what didn't. 20 gets a little cloudy. But if you go out to very simple a year, you can see that the lows mark the bottoms. And they don't have to be down here. It doesn't have to be that way. But you need to have a low. And how do you know you have a low? You'll start curling up. Well, we're very far off from curling up. I think everyone can see that. That is really not close to curling up. And you can actually even see the delay from when you're here and you roll to when it actually starts to break. So these are two things that I think are very telling. And quite candidly, I don't think that either one is really pointing to something that is bullish. And we really wanted to see these start to take hold and show us some more bullish signals. But quite frankly, we're just not seeing that. I want to spend a minute going through the market internals. Now, when we go through market internals, the easiest way to go through market internals is just to look at where the S&P is in relation to its moving average, and then you kind of get a sense of what's going on. So one of the things I'd like to do is that, and then I think we should be reviewing sectors so you can see what's truly going on out there as I describe this. But we're going to start here with the S&P. Let's get my arrow back. S&P stocks above 5-day average. That is S5FD. And you can pull this up for yourself on TradingView for free. Now, anytime, this is a short-term indicator of overbought, oversold. Anytime that you are up near 90 or greater, you can actually drop this down. I look for extreme readings, and you can see that I even have an alert set on it. Anytime that I'm up at 95 or greater, this is set at 96, I want to know, because that means that the market is grossly overbought and that you are going to see some kind of pullback. Matter of fact, if you come here and you look at a reading of 9, this is when we had the Fed speech, and you can see right here on Friday, August 18th, that showed a bottom. We bounced all the way up to August 31st, and that gave us a top. So you have Friday, August 18th, and you have, as for 9 reading, and you have a 96 up here on August 30th. Now, just to show you how simple this is, that is August 18th. That is August 30th. Is it an exact science? No, but I do find it interesting that you peaked right there on that number, and then once you peaked there, you never had another close over. And now you're back down to what reading? A 9, right where you were here. Now you can spend time on your own, go through any of these, and look at where you're at. Why am I saying this? I'm not saying the market is going to turn, and you're going to see another indicator that I'm going to show you in a moment that is going to confirm this when we start getting into some deeper data here. But what this is going to show us is that we're grossly oversold here, and we must pay attention to this. Now, if we use the same data system, but we use a different moving average, which I would strongly recommend that you look at all these because they all tell you a different story. That tells you where you're going in the next week or two, maybe. But when you start getting to like a 90 reading, and this is the 20-day, and this is S5TW, Trading View, you can do this for yourself. Anytime you get to an 8 or 9, you're probably putting in what we would refer to as a swing trade bottom. And guess what? You're nowhere near that, guys. So what this is telling you is that the 5 is telling you that you're probably going to bounce a little bit. And then after you bounce it, you're probably going to come back down and possibly retest here. Does that have to happen? No. What I like to do is I like to look at probabilities. And the probability is every time we're over a 90, we hit a 9 or an 8. Over a 90, we hit a 9 or an 8 or a 1 before we hit another 90. Hits a 90, guess what we do? An 8. Hits a 90, right? 90, it's an 8. It's a 90, not this time. Matumboed here, right around that 18 level. It's a 90. Now, the probability by what I just associated from these 5 times is 4 out of 5, you hit a 9. Doesn't mean you're going to do it this time. Statistically, you need 30 for it to be a statistical significance, but we're not going to get into all that. What we're going to look for is we're going to look to see if it gets to 9. If we see it turn, then maybe we pull this, but at least we know what to look for. Now, the next one we should click through and take a look at is going to be stocks above the 200-day moving average, and then we're going to get into the 50s as well, and you'll see why I waited there. Every single time you are below 50, that is your demarcation line. S5TH. You can do this for yourself on TradingView. It's free. And what you can do, other services have this. I have other services that have this as well. But what is this telling us? This is telling us a couple things that I think we should be paying attention to. Number one, if we're below 50 and you're going long the S&P, I'm just going to say it this way, you are setting yourself up to underperform, especially if you're dropping down. If you're under 50, you better darn be in the trenches. You can see how it's crazy how that works, right? There's a 9 level again, and guess what marked the bottom of the market? Okay, it's not rocket science, guys. Got to 50, and what did it do? Got matum and got rejected. Got all the way up here. You usually don't get over 75 and 80 unless the Fed's injecting $1.7 trillion into the market, but who am I to say that? So here's 50 again, and you're rolling down. Now you're at 41. You're in no man's land. So you're going to want to watch this long term, but this does not make me feel warm and fuzzy long term. Short term, I think you can bounce and then do something like this and then maybe do this again. And I think you have a short bias right now. I think we all see the short bias. But let's look at the 50 because this is where it gets really interesting to me. And I saved this for last for a reason in regards to these. Again, this is the 50-day FI, and right here it is TradingView, and you can do this yourself for free. So why I found this one, and I wanted to save this one for last, is because I also look at trends. I don't like this trend. There's trends I've seen before. When I say I don't like it, people will say, well, that's because you're not bearish. I'm net short, but that's not the point. If the market goes down, people get hurt. So I'd rather just be bullish. I mean, we all know that, if the economy gets bad, people lose their jobs. There's a reason I'd rather have the market go up. But nonetheless, you see this trend line right here? Okay, now I've got this. All right, and then look at the timing of when this was going up. So if you look at when this was going up, what was happening between here and here and here, right? We had the Fed injecting what? 1.7 trillion, and we had the greatest stock market you had in 20 years, and everybody was a genius. And then we crack here, unable to get over this trend. I don't care if you think this is a trend line or not. I chart everything, and you can all see the higher lows there, and you can all see the lower lows here. Until when? When you stop getting a lower low and get a higher low, right around September, October. Where does that take you into January? January spikes you up here, takes you back to 18, right where you are now. An 18 reading is excessive, except if you're going to make lower lows. And guess what we're doing? We're making lower lows. So this is definitely something that we're going to want to pay attention to and keep an eye on. I should, quote, should start bouncing around this area. but I cut this, just like I cut this one. So is this the beginning of a new trend that's going to lead to lower lows and a lessening of the breadth of the market, meaning a weaker market? Or is this just an anomaly and I'm overthinking it? I don't know the answer to that yet. I'm sure you guys will comment below. And I do read all the comments. They don't have to all agree with me. I like when they don't agree with me so I can think differently about my thesis and what I'm looking at wrong. So feel free to comment either way. But this is a great way of using those 4 indicators to get a real clear read on what's going on in the market. Now, it's always important to look at both sides of the coin. So I want to go through short-term risk levels and what this is telling us. And I would like to go through the last hour. But we're going to start here after we just looked at what smart money and dumb money is showing us after we separated it out. And the reason for this, and I want people to get this, there are waves within waves of the market. Everybody can see this long-term trend over the course of a year. In between this, you're getting waves of movement in this trend. And in these waves, there's other waves. And that depends on your time frame and how you're trading. Why is this important to understand? Well, short-term risk levels are exactly that, short-term risk levels. This is really interesting data and the way they compile it. We're about to get into that. But bottom line, when you're over, you might be getting to a point of underperformance. When you're under, that's really where you shine. If you take a look at the under here, you'll note that it's really marked pretty much every bottom that we've had. And if we even go out 3 years, we try not to include a lot of the nonsense from a pandemic for obvious reasons. But if you look right here, you'll see these bottoms. And again, this is a short-term indicator. And what it's doing is it's calling bottoms. If you just kind of look at these little buttons that I'm clicking on, and once you get that, and now you know where we are, what we want to do is drill into this and take a look and say, okay, well, we're sitting there. Well, that's great. What does that mean? Well, let's talk about how they calculate this data, and then we'll come back to the chart. Now, what this shows you is extreme readings, above an extreme reading, between extreme readings, and below extreme readings. And then it tells you what percent of the time you're there. Only 5% of the time you're there in regards to below that extreme reading. You're usually in between them and only above. When you're above there, your annualized return is -12. When you're below that extreme reading, your average return is 32, and that is annualized. Well, that's interesting, something we should pay attention to. So what are we actually calculating here? The correlation, the correction risk level is a quick way to gauge our indicators and studies are suggesting. The higher the risk, the more likely the market is to decline. The higher the risk, the more likely the market is to decline. Another way to look is in terms of cash. If the correlation risk is 0, then we'd be more to keep 0 of our portfolio in cash. So they're using it even to determine risk levels or cash levels. If the correction is 10, then we would keep 100% of our portfolio in cash, okay? How do they calculate this? It's based on a short-term indicator score. Intermediate term correction level is based on the spread between smart money and dumb money confidence indexes. The intermediate correction risk level is based on smart money and dumb money confidence indexes. Short-term correction is based heavily on the short-term indicator score. In both cases, we take the overriding trend of the market into account. If the indicators are showing excessive amounts of bearish, then the markets are more likely to respond favorably if we're in a bull market. The correction risk would be lower, but if we're in a bear market, then bearish sentiment is less reliable. Makes sense, doesn't it? We take our studies into account as well, so if the indicators are murky, we have some very compelling studies to suggest the market should rally, then the correlation risk level might be lower as indications would suggest. The default level is 5. All right, so now you understand what they're looking at, how it's calculated. Now, what we want to do is just take a look at these levels. We can even use October as well. But I only really want to use 12 months so that we're not drilling it in and we're not going to make it too bold. And what you can see is you can see exactly where those lows are. So if we drill up from those lows, we can see right here and here, and this is where we're at. Now, I would argue that that does not mean that you're definitely going to stop there. What I would suggest it means is that this is exactly what we have going on. This is where we're at right now. And it doesn't mean that you're just going to go up on Monday. You can absolutely go lower. You can absolutely come lower. You've done it before. And you can absolutely understand that you're going to want to reverse off of this before you probably would utilize this. It does not mean that you're going up. So if you even take this area in here from whence this happened and you come across, That's 1228. And you would have to go all the way over with this indicator going up before you even moved. So this took over a week for this to even kick in. This could be the same thing. This could take a week. It could take 2 weeks. When you go back and take a look at it, sometimes 310 before you started really moving, you're at about a week. So this could take time. What I'm suggesting is we're hitting a point here where on the short-term risk side, we're getting an indicator here that's telling us that we might be bottoming. It is one piece of data that we should pay attention to. Now, on a longer-term time frame, this is the last hour. Let me clean all this off. This is the last hour. Now, the last hour charts exactly the last hour of trading. If it's positive, they go +1. If it's negative, they go -1. What we've been talking about, and we talked about this previously, we talked about this cup and how we were coming out of this cup and how we were going higher here before the market even started to move. We had this kind of trend right here where we were hitting higher highs over a period of time while the market was going down. This takes a while to catch up. This is a long-term trend indicator. We're going to go through that in a moment here, but this moves out months. What I don't like is the last hour over months. We have nothing but selling the last hour. The reason that the last hour is so important is because that's when institutions move. So a lot of the data that I show, I'm not looking to correlate data to what's going on. I'm looking to show you data so that we can make a more informed decision. If you look at the data that's been presented, the way that we should look at this is short term, we might bounce. Long term, we might have a problem. Till what? Till we start seeing institutional support. As we looked at smart money, dumb money, it's very clear they're not buying in the last hour the way that they were before. You could buy in the last hour right before like June, July, right before in here you were able to buy. And if you remember what this date is showing you and where the high of the market is, we all know that that's when Japan spoke, and we did that piece about a month ago. But from that time on, what's happened? Well, they're not buying in the last hour anymore. We want to see this change. For a refresher, they have it as a medium-term indicator. I use it as a long-term indicator. I wanted to understand the trend on what's going there. But the last hour down here is a cumulative advanced decline for the last hour of trading on the SPY ETF. If the last hour is trading up, it's +1. Added to the advanced decline, cumulative, they just keep going up or down. The trend model applies moving average to the advanced decline, looks at the advanced decline in instances. I'm not using a moving average. You could use a moving average. Once a trend change occurs, the model buys and sells the ETF, which is favorable or unfavorable. What I'm pointing out and what I think is important is not to overlay a moving average, which of course you could put a moving average in here and watch it move and watch it slice through over here and then watch it break over here. Of course you could do that, and that's fine. What I'm suggesting is that I want to know what kind of participation is going on in the last hour by institutions. And it is very clear that we are seeing a depreciation of last hour buying. And if we look at when we saw an appreciation of that, well, eventually it kicked in and we did fairly well based upon that, didn't we? So long term, we need to pay attention to this. Let's look at some stocks. As far as stocks to look at, we're going to keep it very specific, shorts and longs. I'm looking at this ULTA on the weekly. You can see the break right here, the rally, the breakdown, the 3-bar pattern down here, and then the crack. Now, whether we call this a 3-bar pattern, I don't care what we call it. See this long bar down on the weekly? See, you spent 3 weeks and you couldn't even get up 50% of that bar and then you cracked. I don't really see how we don't get to that 374 level. I'm going to be real specific on the short side here, guys. I do tend to look at the weekly charts. This looks really weak to me, the way you're rolling over. I don't see how this doesn't continue. I'll show you another one that I actually thought was going to bounce and was looking at going long for a quick trade. This is a massive, massive break on ELF. And this was one that we were really talking about in the room, candidly, about going long. I'll show you it on an hourly. And this is the kind of stuff that starts to scare me a little bit when I see this. When I see I can't even bounce. So let's clean this off. Let's go into the hourly now with nothing on it. And let's just get into it. So for me, looking at this, what I was saying, someone brought it up in the room because I don't obviously have all the great ideas, but when you see this and you see 114, I figured, okay, 114, maybe we could make the argument that 116 and a half, 117 level, there's a lot going on there. Let's use the low of the wick, the breakdown, a retest of that level. I mean, that seems realistic. Maybe the gap fill in here. There's a lot of little spots up here that we could bounce to. And then you see a bounce of the neckline, and then you might short. We got no love. And that's scary to me. When you see stuff like this and you don't even bounce, and this was one of the be-all, end-all names that you had to own this name if you were in the space, and this is what I get, and then I get this on Friday, and I can't rally, and then I start challenging the low of that bar. I'm going to be real clear about this. So I do get into this kind of detail. This is the hourly, 1-2 up, couldn't hold, breaks, can't get over that bar, right? I mean, I do get into this kind of detail. Can't get over this bar ever again. Can't even get up 50% on this bar. Boom, boom, same pattern, same superheated, breaks low, but doesn't close below there. Why? Why didn't you close below 105? And you look at this and go, well, maybe there's a flag there. Or maybe someone's just pinned to the 105s that expired yesterday. This was filmed today on Saturday at the time of doing it, just early in the morning. So when I look at something like that, it's definitely something that gives me pause and gives me concern. You drill into this on the daily, that's a reversal. That's the exact opposite of a piercing pattern. And that's scary. And that's happening in the big names that you want to be in if you wanted to be in the beauty sector. You wanted to own ULTA, you wanted to own ELF. Now you look at this and it's like, that's really bad. Now, if I look at this from a weekly perspective, I just want to put this again into perspective. You go back to June 22, you're below the 12 week, you're below the 22 week. There is very rare do I break like this and then not get some test of a 55 week. I'm just going to say how this works for me and where my mind goes. And that puts you at roughly, $80. And that's definitely something that I'm looking at saying, can this get there? And if this gets worse, yeah, you're just breaking here. So these are two areas that I am looking at. All I'm telling you is I'm looking at these and these look god awful. I mean, they look like they're ready to fall off a cliff. I was hoping for some kind of bounce before them, but we're just not getting it. So these are two names that on the short side that I am hyper focused on. You need to pay attention to this. When you start seeing necklines being broken, no one's paying attention to them. Nobody's talking about them. Here's your neckline. We can call this whatever you want to call it. I don't care if you call it a blueberry. You can see the break up, 1, 2, 3 down, and then the flip over. There's a pattern that I use a lot, rising 3, falling 3 patterns. They don't have to be specific. They should be up, 1, 2 down, then up, encapsulating the whole. This has got a little tag right here, but you flipped. You want to pay attention to when you see these. You do not want to sleep on these kinds of moves. They are telegraphing what's happening. And whether you want to believe it or not, I always like to say that gravity doesn't really care if you believe in it either, but you can see how you're shifting. Throw in the moving averages, and quite frankly, you can see that how we held the 55. I use a 55. You should use whatever you're comfortable with. You're already breaking out, guys. You're breaking out. You can say whatever you want to say about it. The way that I would use this is relatively simple. I mean, there's your neckline. I'm trying to be real specific to this week, guys. Comment below, please. And thanks for sharing these. I see the shares, picks it up. I specifically do not run ads or sponsors in here to not waste your time. I get asked all the time for it, and I just don't want to waste people's time. So I appreciate your comments, and I appreciate your sharing it, and that combats the algorithm. Thank you. So here we are, and you can just see the push off of there. Okay, so we have that push off of there. Here's SQQQ, you're at 20.5. What are you going to wait for? You're going to wait for it to be at 24, 25? When would be the right time to buy this? You want to be in these first. You don't want to be last. You can see the 55. This was a great time to get in. We talked about it in the room. We didn't do it because we had others on that we were trading. And you can see how this is acting right now. And you can see what's going on there. Very specific here, guys. Go back and take a look at what we said earlier about, let me clean that off. What we said earlier about where we're at in regards to stocks on the 5-day moving average as well. You're going to have volatility here. But look at this. Here we go again, closing above the 55 on Tesla. There was a really negative article. I couldn't figure it out. And I'm going to just be honest here so everyone can just disclose. I'm net short Tesla. I have puts on Tesla. I'm short stock on Tesla. I have a decent sized net short position on it. It is very difficult to look at that chart and not want to be short. I'm just going to show you a couple things here. So number one, you have this island reversal. You have confirmation of the island reversal right here. There it is. It does not get any clearer when you look at this. You can see an island reversal here and how that acted. Similar pattern, same soup reheated. I think this is really important to stay focused on a couple names here, but when you look at this, you really want to pay attention to that. You're breaking down here, pop in our moving averages. I use a 12, a 22, and a 55. You should use what you're comfortable with. See how the RSI is breaking right here? See how this is a perfect bar, a perfect down bar. Let's call them black. Okay, you don't want to play with that. It has a high degree of probability of having follow through. It's roughly around 60% if you go and take a look at Bukow's book on candlestick pattern recognition and his back testing. So I don't want to play with that. And I didn't play with that. I'm net short that name and we're net short that idea. A lot of guys were in this trade way earlier than me that are in the room, candidly, because I was focused on some other names during the day. But this makes a lot of sense to look at. And the Barclays article about that sales or deliveries are way off from June. That came out, and I think that's why you're seeing pressure. There's some talk about something going on in Mexico with a new delivery of a new priced vehicle. But this looks to me like you're setting up for a major break. Not a small break, but a major one. And there's different ways to play that, and you can kind of go from there and figure out your best strategy. But I want to focus on this. And now let's say we bounce, and we went through those sectors, but let's say we bounce. I would be looking for stocks like Google that are not breaking their 12-week moving average, that are in these trends, that are just pulling back to levels and holding. Look at this on the daily, and look at what's happening here. Here we are again, right on the 55. Now, I don't know if this holds. I don't have a clue if this holds. If we see that we broke the 50 here, we broke the 50 here, and we held, this is what we want to see, and that's what we're seeing. So if I had to go out there and look for names, it's going to be strong balance sheets. It's going to be Google. It's going to be Meta, which I already had a trade in Meta, and it did not work. But it's going to be these names. It's going to be strong balance sheets. You can even see Apple in here and its inability to break that 173.5. But I have a declining 55. So I have to rent Apple, not own it. Microsoft is another one. Extremely strong balance sheet. Goldman is pounding the table on this thing weekly, and nobody cares. And I've got a declining 55. So that brings us back to XLC. It means I look at Google. It means I look at Meta. Another sector, real quick, I'm just going to throw this out there that you should really be looking at is something like Netflix. I understand the breakdown. Eventually, this strike will end and there will be a move. But until then, you need to hold in here. Like if you start cracking in here, see these patterns, up, 1, 2, 3 down. I know it's more than 3, but you get the pattern. It's all about recognition. And then you just want to watch how you hold in here. But I want to go back to 2 that I think are really important. This is something that I have a position in. I rarely do this. I do some of these air funds, but this to me just looks like a no-brainer, guys. You're just closing over that 55. It's definitely something I have an interest in. I'm already short Tesla stock. I already have puts on Tesla, and I'm net short in other ways as well. And I have this. I can't be any clearer about where my position is on Tesla at this particular time. Does not mean I am right. I've been wrong before. I will be wrong again, right? It's all money management. The other one that we're in and we're doing quite well with is this SOSX, and I would take a look at this and see how you're acting in here and see how these moving averages are starting to spread. You think you're late to this? I would suggest that if this gets worse, which it could get worse based upon what we just did, when you see pullbacks on this, you might want to take a look at this as well. That's it.